If you make over $250,000 a year, this is probably going to sound pretty familiar. On paper, everything looks good, but behind the scenes, things feel a little chaotic and you're not exactly sure why. As the promotions stack up, your financial life gets more complicated and you start to feel like you're simply not doing enough. So today, we're going to walk through 7 simple yet incredibly valuable financial ratios to help you actually understand where you stand with your money and how to feel more confident about it. So stay with me through all 7, because by the end, you'll know exactly which one that you should focus on based on your unique situation. During your high earning years, your cash flow really lays the foundation for your financial plan. And what we're looking at here is going to be your element scorecard. This is what I use with clients to help them better understand their financial situation. And it's going to be the foundation as well for today of what 7 ratios that we specifically look at. So when it does come to cash flow, there are going to be 4 main places where your money can go. You can save it, you can spend it, it can go towards debt, or everyone's favorite, just kidding, it could go towards taxes. So to kick off today's video, one of the most important rates that we're going to look at right now is going to be your savings rate. Your savings rate is going to be calculated by adding up your annual savings. This could be to retirement accounts, health savings accounts, brokerage, checking accounts, any other bank accounts. So how much you're saving on an annual basis, and then you divide this by your annual income. So in this sample client that we have right here, this couple would be saving $66,000 on income of $270,000. So their savings rate, as you can see the calculation on the screen, is going to be 24%. Now, if you're not at 24% right now, that's totally fine. For context, as a high earner, you're likely making over $250,000 a year. Above 15% is when your savings rate starts to become pretty healthy. If possible, it's nice if you can get that number a little bit closer to 20, but 15% would be a solid starting point for you. And then a few of the different items that might make up your savings rate, like we talked about at the very beginning here, as we go through here, we can see this particular sample client is saving $637 a month to their savings account. We can go down here and see that they're contributing to a thrift savings plan. It's a retirement account, as well as RSUs. So I want to really quickly double click on this one here on the restricted stock units, because as a high earner, there's a really good chance that part of your compensation is in the form of these restricted stock units, where maybe that's every quarter or biannually, on some sort of basis, the company is giving you stock. A lot of people don't necessarily factor this in when they think of how much they're saving on an annual basis, because money didn't necessarily come to them first, say through a paycheck, and then money went out. Whereas if we're looking at a checking account or a savings account, for example, that money actually hits your account and then you transfer it over, in this example, roughly $640 to savings. But since this sample couple isn't spending their RSUs, that actually counts as savings, because if the company gives you stock, you likely have some of that going towards taxes. Their sell to covering is the fancy jargon term. But then the remainder, if you're not selling it, that absolutely counts as savings. So what I found, a lot of high earners will think that they're not saving enough, but once we do factor in their RSUs, that's when their savings rate starts to look a lot more healthy. So that's just a bonus tip for you. Make sure you are including your RSUs in your savings rate, assuming that you're not selling them to cover short-term spending needs. And the reason why savings rate is one of my favorite ratios on this element scorecard, especially for high earners, is once you have this number in a healthy range, again, we'll say above 15%, each situation is slightly unique, so I'm speaking a bit more in generalities today. If we were to work together, we would dive in and figure out what specifically does your savings rate need to be healthy for your unique situation. But once we've determined that your savings rate is healthy, then you don't necessarily need to budget. At least not in the traditional sense. It's of course important to track your spending, have an awareness of where your money is going on a monthly basis, and a telltale sign of overspending would be your credit card balances are going up every single month, or you're having to pull from savings every single month to cover spending. So assuming that's not the case, and you have a healthy savings rate, you don't necessarily need to operate on the classic budget, because you have already automated savings for your future, as well as being able to spend money in the present. Speaking of spending, our next ratio is going to be burn rate. So burn rate is going to be all of your spending minus your debt divided by your income. So this shows what percentage of your income you're spending. So in this example, this sample couple is spending roughly $78,000 a year, and on their $270,000 of income, that represents about 29%, as you can see on the screen. So this number is going to vary widely. So it very much depends on where you live. Of course, if you're in a higher cost of living area, I happen to live in Southern California, things aren't particularly cheap here. We would expect your burn rate to potentially be a bit higher. Of course, your family size, the larger your family, of course, all things equal, the more money you're going to be spending on a monthly basis. And then it's also important to know whether you own your home or whether you rent. Because if you own your home, your mortgage is going to count towards debt. Whereas if you're renting, that's going to go into your burn rate, into your spending. So if you're renting, your burn rate likely is going to be higher, all things equal. So now for context, again, each situation is going to be a bit unique, but probably somewhere in the realm of 25% to 50% is going to be a relatively typical range. Again, you'd have to factor in your own unique situation, but that at least gives you some level of ballpark on how much you could be spending on a monthly basis. And really quick, because it's this important, if you already have a healthy savings rate, you're automating your savings, this number is really more just for an awareness, because we already know that you'd be saving for your future. So just make sure that you have an awareness of it and you're not overspending, because overspending is what's going to derail your long-term financial plan. Now let's move on to debt rate. This is going to be the same as your debt to income ratio, where you take up your annual debt payments and you divide them by your gross income. So what percent of your income is going towards debt payments on a monthly basis? Now, for context, the generic rules of thumb typically say you don't want this number to be more than 36%. Each situation, of course, is unique. I feel like I'm a broken record on this in today's video because personal finance is more personal than it is finance. But from my experience, once this number gets above 30%, that's when things can start to feel a bit tight. So in this particular example, their debt rate is 33% because they have $88,000 of debt payments each year on that $270,000 of income, and that represents 33%. So each month, a third of their gross income is going directly towards debt payments. Now, for you, depending on your upbringing, your thoughts, and your feelings towards debt, you might want to absolutely keep this by 30% at all costs. Maybe you had a really poor experience with debt, or you saw your parents struggle with it growing up. Maybe you have an aversion to debt. You might want this number to be below 20% or even 15%. So again, your results are going to vary in what yours should specifically be, but it's really important to at least know what your debt rate is so that you can start making calculated decisions on, should I invest or should I pay off more debt? Well, depending on what your debt rate might be, if you pay off one of your loans, how much is that going to free up on a monthly basis? How much would that decrease your particular debt rate? So as we can see, as part of cash flow, debt is going to be incredibly important because money that's going towards your debt rate is of course not able to be saved or spent. It's important to note that there's also good types of debt and bad types of debt. Now, well, that's not the entire purpose of this video. I just wanted to briefly walk through the example with our sample couple right here. So as you can see, 33% of course is going towards debt payments. But if all of this was going towards credit cards, and only if you're carrying a balance from month to month, that's when it would get factored into debt rate. But if they did have that, if all of their debt rate was going towards credit cards or personal loans, or they just have massive auto loans, that might be more concerning compared to if we click into this sample couple's debt rate, we can see the majority of this is going towards their mortgage. So mortgage is typically going to be considered more of a good debt because, of course, we have to live somewhere. And if you can afford to live, making sure that you keep your debt rate in check, that's going to be helpful. Now moving on to our final cash flow number is going to be tax rate. Everyone's not so favorite cash flow number because we have a little bit less control on this one. So whenever it comes to cash flow and calculating tax rate, I like to factor in not only your income tax at the federal level, I also like to factor in what's called your FICA, which is your payroll tax. So if you're an employee, you pay roughly 7.65% of your income to the Social Security and Medicare. You'd be able to see that on your pay stub. I like to include that here because we're trying to figure out with your cash flow where all of your dollars are going on a monthly basis. So your federal income tax, your payroll tax, which is also going to federal. And then if you live in a state that has income tax, and again, in California, we certainly, unfortunately, have pretty high state income tax as well, we would be factoring that in. Now, as far as, well, Brandon, how much should my tax rate be? Unfortunately, the answer is it depends. And this one is incredibly nuanced. Your tax rate could actually vary from year to year. There could be a particular year that you have a lot more deductions. Maybe you were particularly generous in one year and you had had more deductions, which lowered how much of your income was going to be taxed. And in that particular year, your rate was a little bit lower. There could be another year where you simply didn't have as many tax deductions and your tax rate is going to be higher. So when it comes to this, I help my clients with a proactive tax strategy where reviewing their previous year's returns or projecting out, in this case, the 2026 return to see what proactive levers can we utilize to lower this tax rate legally, or not just look at it from a year-to-year basis, but also over the lifetime of someone's wealth. Again, your results are going to vary. Your specific tax rate is going to depend on how much you make, where you live, whether you itemize on your taxes. Are you a business owner? Do you get paid W-2 income? So there are just so many nuances and so many factors that I can't get into in this video today. But once we figure out what range we would expect you to be in, that's where we really get into this proactive tax strategy on trying to lower the overall tax rate over the lifetime of your wealth versus just finding ways to get all of the deductions in one particular tax year and save a bunch of money today on taxes, but then have a large looming tax bill hanging over your head for the future. So again, we just want to make sure that we have a very specific, very intentional, proactive tax plan, tax strategy for your unique situation. Now moving on to one of my absolute favorite numbers on the Element Scorecard is going to be your liquid term score. So you take your cash plus your brokerage accounts, and then you divide that by your annual spending. Effectively, what it shows is how many years could you live on the assets that you can quickly access without any more income coming in. So in this client example here, with a liquid term score of 4.4, they could stop working tomorrow and, not assuming taxes, inflation, growth, any of those types of assumptions, they could live for just about 4.5 years on money that they can quickly access. And even getting in really quickly to this topic of liquidity. So what I mean by liquidity is, of course, you can go to the bank and transfer money nearly instantaneously. If you have a brokerage account, sometimes referred to as a taxable account, basically not a retirement account, you can take money within a few days, so very liquid, compared to something that's not as liquid, that would be your retirement accounts. You might not be able to take money from your retirement accounts, at least without excessive taxes and penalties. Of course, if you own real estate, that's not liquid because it does take a good amount of time to be able to sell a property and then convert it into cash. So that's what we're meaning by this fancy jargon term of liquidity. And the reason why the liquid term score is one of my favorites on the Element Scorecard is because this really helps you with peace of mind. For example, I worked with a client a few years ago who had a very large net worth above $10 million, but their liquid term score was very low. So even though on paper, their net worth, which we'll get to in a moment, was very large, they simply couldn't access very much of it, and that caused them a lot of stress. So if you're stressed and you don't see this number at least around 0.5, which would indicate 0.5 years or 6 months, then that's likely one of the, if not the main source of your financial stress. Now, once your liquidity or your liquid term score does get above probably the 0.5, depending on your situation, if you do have a large purchase coming up, say you're saving up for a down payment, that's going to change the calculation a little bit. Let's just say that your emergency fund, and there's no other short-term purchases, hits that 6 months, roughly 0.5. Now you can start looking at investing additional money on top of that. So instead of having, in this particular case, we wouldn't want to have all 4.4 years of liquidity saved up in just cash or in just a high yield savings account. So what we would do is we would work together to proactively determine, well, how much should we keep in that emergency fund? Are there any other short-term goals like buying a house in the next couple years that we want to make sure stays in something like cash? And then for money beyond that, we would invest that into a brokerage account with a long-term objective so that you can have a better chance of growing your wealth, building your wealth, but in that brokerage account, you still have plenty of access to it. So how that could work, especially as a high earner, right now, you're probably working a lot of long hours, and maybe you're thinking, what if I could just take a sabbatical for a couple months? 3 months, 5 months. Now, of course, your employer would have to be okay with this as well, but at least if you have this liquidity, you have this large brokerage account growing, you have plenty of cash reserves on the sidelines as well, you're going to be in a much better position to take that sabbatical if you want. Or, God forbid, there's a round of layoffs and it hits you. That's, of course, still going to be incredibly frustrating and very tough and challenging. But if you at least have some cash reserves and you have a healthy liquid term score, you're going to be able to navigate a layoff situation much more effectively compared to if you simply didn't have much in your cash reserves or you had this low liquid term score. So, as you can see, this is exactly why it's my favorite, where if this number is low, build a plan to increase it. And if this number is already healthy, and in this example, this is very, very healthy, just make sure that you don't have too much money sitting in cash on the sidelines, and you determine at which point you want to start investing some of that money so that you can continue to grow and build your wealth. Now, moving on to the sixth number today is going to be your net worth. So I just briefly teased that whenever we were talking about liquid term, but your net worth is going to be calculated by taking your assets, so that's everything that you own, and subtracting out your liabilities or your debts, everything that you owe. So in this particular example, you can see they've got a net worth of roughly $1.1 million. So this could be because they've got $1.5 million worth of assets. That could be between their house, retirement accounts, brokerage accounts, cash, etc. And then they could have $400,000 in loans. That could be their mortgage, that could be car payments, etc. And that would equal a net worth of $1.1 million. Now, the reason it's important to know this number is this is going to be the number that really helps you determine at what point can you become work optional or retirement. So when it comes to net worth, if we're growing this over time, whether that's through our investment accounts, we're building wealth through our business, we're building wealth through real estate, regardless of the avenue or the vehicle, we want to make sure this number is growing over time, because eventually we'll want to convert this net worth into a way that we can spend money in the future and retire. And that actually perfectly leads me to the final number that we are going to talk about today, which is your total term score. Your total term score, or as I like to call it, your financial freedom number, is going to be calculated by taking your net worth and you divide that by your annual spending. So what this shows is how many years could you live on all of your assets if you were to sell them. Again, not that that's the recommendation, but not factoring in growth, taxes, inflation, any of those assumptions. So how long could you live on your assets? So in this particular example, their total term score is 6.7 because you can see their net worth is 1.1 million. They spend roughly $165,000 per year. Divide the two, and that gets you to just under 7 years. So with a couple that's in their 30s or even their 40s, 6.7, of course, is not going to be enough to retire yet. For context, to retire in your mid-60s, you want a total term score of roughly 25 to 30 or so. That's the point where you're going to be able to likely become work optional and live on the money that you've been able to amass over the course of your life. Another really valuable aspect to the total term score is it really helps put money and numbers into perspective for your unique situation. So let's just take the example of, is $1 million a lot of money? Well, the answer is it depends. And specifically, it depends on how much you spend. Let's say, for example, two people have $1 million. One of them spends $500,000 per year, and the other spends $50,000 per year. Well, it's the exact same $1 million, but to the person who spends $500,000, that represents only 2 years worth of spending. But for the person who has the same $1 million, but spends $50,000 per year, that represents 20 years worth of spending. So that's really helpful when it comes to, well, this person has more wealth than me, or we don't want to necessarily get into the comparison games, but it does really help put into perspective, is X amount of dollars a lot of money? I don't know. Depends on your spending. I just shared approximately what your total term score should be to retire in your mid-60s, but how do you know if you're on track earlier on? So what we are looking at here is just a ballpark of ranges. Again, this is not a hard and fast rule. This just gives you a general guideline on where your total term score should be depending on your age. Of course, the younger you are, the lower total term score we would expect you to have, simply because you have less working years, you're younger, you haven't had the time for compound interest to help really build and grow your wealth. So the younger you are, if you're below 35, we would expect this number to be less than 5 and to potentially grow between 0.5 and 1 per year. So to put that into context, if you spend $100,000 per year and you're less than 35, we would hope that your net worth is growing at roughly 50 grand per year. Again, not prescriptive advice, just gives you an idea on where that could be. Now, once you get into your mid 30s to mid 40s, we think that this number should be closer to 5 to 15 and then growing at roughly 1 per year. And again, the reason that this starts to get easier and easier over time is because of compound interest. For example, if we have two people, one of them has a $100,000 account and they get a 10% return, that equals $10,000, which is great. That same person has $1 million, gets the same 10% return, that's now $100,000, right? So as you can see with compound interest over time, as you get older, as your net worth increases, absolute dollars also increase much faster. And therefore we would expect your total term score to grow a little bit faster as you get older. So even if you're right now feeling a bit discouraged because your net worth feels like it's just not growing very much, but everything else is healthy, your savings rate is solid, your debt rate is in a healthy range, and you're not overspending, then give yourself some grace and keep sticking to your long-term plan. Because once you're in your mid 30s to mid 40s, we want this to grow at that total term growth of 1 per year, be in that 5 to 15 range. And then once you get to mid 40s to mid 50s, we expect this number to start getting closer to 25. That could even grow by 1 to 2 on an annualized basis. And then depending on when you want work to become optional, in your mid to late 50s, we want to start seeing this total term score get closer to 25 or higher. Now, one other thing, a bit of a bonus that should also be encouraging to you is right now we're talking about your total term score with just your net worth divided by annual spending. But once you get into retirement, there's a good chance that you're going to also get some sort of guaranteed income. That might be a pension for you, although those are much less likely these days, but Social Security. And again, really quickly, we don't need to get into it, but Social Security likely will be there in some form or fashion. I don't think that should be the large part of your retirement plan, but I do think it is going to be there in some degree. So let's take that same example of spending $100,000 per year, and we'll say that your net worth is $1 million. We take $1 million, divide by 100,000, and that equals a total term score of 10. But now you know that you're going to get roughly $50,000 of guaranteed income, could be between you and a spouse. Effectively, the money that you need to pull from your portfolio is now going to be that 100,000 minus the guaranteed income of 50,000. So your adjusted spending is going to be 50 grand. So that same $1 million that we thought your total term score was only going to be about 10 has now doubled, because we take the 1 million divided by the adjusted spending of 50,000, and now it's at 20. So again, don't solely rely on guaranteed income sources like a Social Security to exclusively fund your retirement. Of course, don't mishear me. That is not what I'm saying, but it is really important to know that there should be some level of guaranteed income in the future that in those final years leading up to becoming work optional will drastically, or at least potentially drastically increase your total term score and make it look healthier than maybe it is today. Each of these 7 numbers is just a snapshot, but your real progress lives in how they all work together. Say you have a healthy burn rate, but a high debt rate, that's still going to keep you on the hamster wheel and makes it tough for you to get ahead. You could have a big net worth on paper, but a low liquid term score is still going to leave you feeling financially stressed. So when you see how all 7 interact, you can start to gain real clarity on which number to focus on next in your financial life. So here's what I'd encourage you to do. Block off about 30 minutes to calculate your element scores. One likely jumps out as the one causing you the most stress, and you might even be positively surprised that you are doing better than you think. And if you don't have the time or you want help running through this with a professional, I use something called the Maximize Life Method, a simple framework built around 3 areas: today, tomorrow, and forever. Today is all about clarity and where you stand and what to do in the next 90 days, like reviewing the scores that we discussed today. Tomorrow is about building your future with proactive tax planning, investments, and protection dialed in. And then forever is getting your money running on autopilot so work can eventually become work optional while still enjoying your life in the present. Click the link in the description and let's connect on a free 15-minute phone call. Thanks so much for watching, and I'll catch you in the next one.